Hello, it's Tim Moffat here from Oakleigh Investment Management. We were reviewing our FY24, financial year 24 performance and stats for the 18.6 strategic investment portfolio. And just thought it might be worth doing a quick update on a few of the highlights that we picked up and thought were relevant. So at the end of the year, the portfolio increased 15%. That's comparable against the MSCI, which was up about 18%, and the All Ords, including dividends, which was up about 12% for the year. In the year, we saw a fair bit of movement both up and down. So part of the reason our performance wasn't actually ahead of the MSCI was, first of all, we don't have a lot of exposure to the Mag 7 stocks, those mega cap technology stocks. But secondary to that, in late October 2023, when the market broke down, we went into capital preservation mode. The market wasn't behaving entirely as we would expect it to be in the second half expansion. So in our weaker positions, we started raising cash and exiting. And what happened was, out of the end of October into the early November, the market turned on a dime and really rallied quite hard. So whilst we got back into the market pretty quickly, some of the positions that we exited, like some geared US market exposure, we didn't have throughout that strong rally into the latter end of 2023. If we didn't manage to maintain that, the performance probably would have been another 500 basis points or 5% higher. So such is investing and managing portfolios. We won't be sorry for having a clear focus on capital preservation. That is paramount to us. We need to maintain capital where we can. And I would continue to expect that we would approach the market even through the remainder of the second half expansion period, certainly be even more aggressive when we start to move into the bust phase of the cycle. In terms of the portfolio, we noticed a couple of things. So we had 3 of the top 20 best performing stocks in the ASX 200. That was Seven Group, Sandfire Resources, and Virgin. And we only had 1 of the worst performing stocks, Iluka Resources, of which we actually didn't hold. Iluka was down quite materially through the year, and we exited before. Obviously, we didn't hold it up throughout the year, and the losses to the portfolio were about half of what it did in the index. In the top 50, we had 8 of the top 50 best performing stocks. So we can add realestate.com, Reece, Wesfarmers, Combank, and National Australia Bank. And we only had 2 of the worst performers in the ASX top 50. So Iluka, and then the other one was actually Telstra, believe it or not. The losses contributed to the portfolio of Telstra were about half the market. And again, that was because we were exiting weak positions and didn't let it ride out. One of our best performing stocks last year was Austin Engineering. Now, that's not actually in the top 200, but if it was, it would have been the third best performing stock. And that was up about 112% for the year. So look, we think what that all means is we're playing in the right spaces, we're in the right stocks, and the right sectors where we're continuing to focus on capital preservation, even though we're in the aggressive expansion phase. And we think that through the next couple of years, we'll continue to perform well, especially in this growth environment. So if you have any more questions, or you're either already an investor looking to invest more, or you'd like some queries and some information to become an investor, please reach out via the website, or you can just email invest@oakleighm.com.